Hello everyone and welcome back to my channel. Remember 2022? In the Greater Toronto Area industrial market, it felt like the frantic Wild West. Vacancy rates had plummeted to a suffocating 0.6%. Investors, fueled by FOMO, were throwing traditional fundamentals out the window just to win desperate bidding wars. Fast forward to today in 2026, and that chaos has been replaced by a highly disciplined plateau. Before we dive in, quick note, Dean has been in the trenches of commercial leasing for over 10 years. Industrial, retail, office space, you name it. By the way, if you're new here, I'm Dean Aronovich's digital avatar stepping in while he's out doing what he does best, negotiating commercial leases across the Greater Toronto Area. And honestly, if you're a business owner dealing with industrial real estate right now, you're going to want to stick around for this one. Drop him a message or book a call using the link on the description box below. He genuinely loves this stuff and would love to help you out. All right, now let's get into it. We've officially moved from an era of extreme scarcity to a new normal of stabilized cap rates and balanced supply. If you're an investor, the game has fundamentally changed. The era of accidental capital gains is over. Welcome to a highly technical environment where sophisticated underwriting is your only path to success. The most definitive shift we see in the 2026 landscape is the establishment of a hard floor for capitalization rates. The days when hypergrowth compressed yields are gone. Today, the institutional standard has completely recalibrated. The benchmark target for prime, Class A assets is firmly set between 5% and 6%. Let's be clear about the new rules. Anything priced below a 5% cap rate in today's market is considered overpriced. While you might still see tight yields of 4% to 4.5% in highly specific, investment-focused submarkets due to localized demand, those are outliers. For the broader market, a sub-5% yield typically means a negative yield spread when measured against the cost of debt. Investors are no longer willing to pay a premium just for the mere privilege of ownership. They want a return that actually compensates for the illiquidity of real estate. Now, you might hear that vacancy rates have climbed from that historic 0.6% low up to a current range of 4.5% to 5.5%. But make no mistake, this is not a sign of a failing market. It's a sign of a healthy one. That 0.6% figure was a market malfunction that paralyzed mobility. This new Goldilocks zone gives businesses the essential breathing room they need to expand and contract. Because of this, the hyperinflation of rents has neutralized. The unsustainable 20% annual rental growth has cooled to a highly predictable 3%. While landlords who got comfortable in the Wild West might find this jarring, this stability is exactly what allows for long-term corporate planning. As vacancy has normalized, we've seen a massive flight to quality. Investors are targeting modern, high-functioning assets, specifically looking for those priced 10% to 15% below replacement cost. Because space is no longer impossible to find, Class B and C assets must offer a risk premium. This means Class B stock with moderate capex trades at 6% to 6.5%. Class C and functionally obsolete assets are pushing past 6.5% to over 7%. Technically speaking, the market now pivots on a very specific relationship, a 317 basis point spread over the 10-year bond. With national industrial cap rates plateauing around 6% in the first quarter of this year, the phrase "cash flow is king" has truly become the ultimate mantra. In this stabilized environment, you have to be vigilant. Certain metrics are immediate red flags that tell you when to walk away. First, as we mentioned, sub-5% pricing. It represents a negative yield spread and a poor risk-reward ratio. Second, beware of cap rates exceeding 7%. This is a clear signal of functional obsolescence, heavy capital expenditure requirements, or severe rental uncertainty. And finally, watch out for prime submarket assets trading above 6%. This layout often masks a hidden location mismatch or structural quality issues. The verdict for 2026 is definitive. The GTA industrial market has reached a sustainable equilibrium. Net asking rents are stabilizing around a floor of $17.50 per square foot, with a broader range reaching up to $22. Are you chasing the higher risk value-add yields of Class B and C products, or prioritizing the long-term cash flow of modern Class A infrastructure? In 2026, the smart money is choosing the latter. This is exactly the kind of thing Dean navigates every single day on behalf of his clients. Whether you are looking to divest a Class B asset before CapEx catches up or secure long-term cash flow in a modern Class A facility, GTA Commercial Brokers is your advantage. From strategic sourcing to aggressive negotiation, we handle the technical heavy lifting. Reach out via the number on your screen and let's discuss your next move today. Make sure to like, subscribe, and drop your thoughts below. Let us know which topics do you want us to discuss next. Thank you for tuning in today. See you on our next video.